Hey everyone, in my previous video I discussed why next few months can be volatile for the market due to global slowdown and high interest rates. While US market is down 35% from its peak, Indian market is still trading near its peak. So any negative trigger in the global market can also impact Indian markets. It could be COVID, inflation, job loss, slow growth, China-Taiwan issue or something even unexpected. So chances are there that Indian markets can see further volatility in the near term. But we know that the future of Indian economy is very bright and any correction in the market will only create buying opportunity. Now, I have received requests to discuss stocks that are less risky and can be considered accumulating during these volatile times. So in this video, I have discussed 10 stocks that are less risky, that is less volatile and can offer a decent return in 2023. Please note that when you are looking for less risky stocks, you have to look at large caps. Mid cap and small caps can potentially generate higher return but are more volatile. So in this video, I have specifically focused on top 10 stocks that can offer both decent return along with good downward protection. And I'll also share my reason for selecting the stocks. And if you're also looking for mid-cap and small-cap picks for 2023, then let me know in the comments. But before I start the discussion, let me clarify that as usual, this video is for educational purpose. I would request each one of you to do your own research before investing your money. Alright. Let's get started. So the first 3 stocks in my list are from banking sector. I've been saying this for a long time that banking sector in India has the best growth potential and we have seen that in the last few quarterly numbers. And I believe that this growth momentum would continue for a really long time. The simple reason is that after the COVID lows, banking sector has seen sharp improvement in their asset quality and their NPAs have fallen to a historic low levels. In fact, yesterday RBI published its Financial Stability Report where it mentioned that gross NPAs of Indian banks have fallen to 7 years low. And when NPAs are at lowest level, it boosts the confidence of bank in giving loans. And as far as demand is concerned, there is huge demand across your home loan, car loan, personal loan, vehicle loan, corporate loan and so on. So even the coming quarters and years are looking great for banking stock. On top of that, banking stocks valuation are also looking reasonable. So out of 3 banking stocks that you can consider accumulating in a staggered manner in 2023, first pick is ICICI Bank. If you have been following my videos, I've already recommended it previously and I would still recommend it for 2023. In last 5.5 years, ICICI Bank revenues have consistently jumped from 60,940 crore in FY17 to 1.04 lakh crore in trailing 12 months. And its profits have jumped from 11,340 crore in FY17 to 31,108 crore, representing nearly 3x jump in its profit. And bank's NPA has consistently fallen and latest net NPA stood at 0.61%. That shows its strength in asset quality. And it's not just the bank, but its subsidiaries including ICICI Life Insurance, General Insurance, ICICI AMC, ICICI Security are also doing well. That is adding to the profits. Currently, ICICI Bank is trading at levels below 900 and looking attractive with PE ratio of 21 and PB ratio of 3.4. So from current levels, ICICI Bank can comfortably generate another 20-25% return for 2023. So worth adding at current levels and further accumulate if there is any dip. Then second stock is HDFC Bank. HDFC Bank is also growing consistently where its revenues have consistently jumped from 73,271 crore in FY17 to 1.48 lakh crore in trailing 12 months. And its profits have jumped from 15,317 in FY17 to 41,870 crore, representing nearly 2.7x growth in profits. Again, HDFC Bank has one of the best asset quality in entire banking sector with latest net NPA at 0.33%. Currently, HDFC Bank is trading at levels of around 1640 with PE ratio of 22 and PB ratio of 3.6. I expect HDFC Bank to potentially generate around 15% return in 2023 from current levels. Then third stock is Axis Bank. The reason for selecting Axis Bank is sharp improvement in asset quality and sharp growth in business. Axis Bank revenues have grown from 45,175 crore in FY17 to 75,838 crore in trailing 12 months. But more importantly, its asset quality has improved drastically with NPAs falling from highs of 1.2% in June 21 to 0.51% in September 22. As a result, bank's profits have grown exponentially. So profits after falling from highs of 5,047 crore in FY19 to levels of 1879 crore, it has jumped exponentially to current levels of 18,464 crore. Although bank share price has already jumped in recent times, but in spite of that, it is trading at P ratio of 15.6 and PB ratio of 2.4. So in terms of valuation, currently Axis Bank is looking most attractive among the top private lenders, and its acquisition of Citibank business should also augment its growth. Hence, Axis Bank can still potentially generate another 20-25% return in 2023 from current levels. Now, you might be wondering why I have not discussed PSU banks that have seen a crazy rally in 2022. Because personally, I am not a big fan of PSU stocks for long term. I always believe that private sector banks have much better growth potential than PSUs. Although PSU banks were highly undervalued in 2021, that resulted in sharp growth in 2022. But I would always prefer top private banks over PSUs. Okay, before we look at the next stocks, I have a special announcement. I'm offering additional 15% discount on all my money management courses for this new year. But it is limited only for a few days. I provided the code and course detail in the description and pinned comments. Now, next two stocks are from evergreen FMCG sector. FMCG sector has been a hot favorite of every investor because no matter what, we would continue to consume products like tea, coffee, toothpaste, soap, shampoo, dish cleaner, toilet cleaner, etc. And consumption is one of the biggest themes in India for the next 20-30 years. However, of late, FMCG sector is not getting that traction. One of the reasons is overvaluation of stocks in FMCG sector, and another reason is rising inflation that impacted the margins of FMCG companies. However, if you have a long-term viewpoint, you can always add quality FMCG stocks in your portfolio. So my fourth stock is HUL. Now I don't have to discuss about HUL. 9 out of 10 households in India consume HUL products like your Lux, Dove, Lifebuoy, Lipton, Brook Bond, Clinic Plus, Close Up, Domex, Lakme, Surf Excel, Vaseline, and the list goes on. And the consumption of these products will only increase in the future. And HUL has a highly profitable business with negligible debt. It is a free cash flow generating machine. Currently, HUL is trading below levels of 2600 at P ratio of 62, which is slightly below its 5-year median of 68. Now, considering the volatile market, HUL is one safe bet with very low downward risk and can potentially generate around 15% return in 2023 from current levels. Then fifth stock is ITC. While 2022 was not favorable for other FMCG stocks, ITC has seen a crazy rally. The most trolled stock of 2021 has seen more than 50% jump in its share price in 2022, and that too when other FMCG stocks have not generated much return in 2022. And it is a big lesson for investors who just make an opinion about a stock on the basis of its past return. For entire 2021, ITC was trading at levels of 200, but majority of retail investors made fun of it. And look at where it is today. I even created a video on ITC in 2021. Anyways, even after more than 50% rally, ITC is still trading at P ratio of 24, which is still very reasonable, and I expect another 20-25% return from ITC in 2023. In fact, there are also discussions around demerger of ITC businesses, including hotel and FMCG, that can also further unlock the value for ITC. And let's not forget, it is one of the top dividend master. Now, sixth stock in my list is from infra sector. It's L&T. This infrastructure conglomerate is a leading player in every possible infrastructure activity in India, right from your construction, mining, heavy engineering, hydrocarbon, defense, power, and the list goes on. And we all know that Indian government is spending a huge amount of money on building the infrastructure of our country. It is clearly visible in the order book of L&T that now stood at 3.7 lakh crore, which is more than 2 times its last 12-month revenue. Out of this, 71% order book is from India. Also, the fact that 2023 is the last full budget of current government before the election in 2024, and the government would focus on capital expenditure to grow the economy. This should directly benefit L&T. Currently, it is trading at levels of around 2100 at P ratio of 31 and can potentially generate another 20% return in 2023. Now, my seventh pick is another conglomerate with leadership in telecom, retail, and energy space. It's none other than Reliance. Over the last few years, Reliance is transforming from being an oil major to a retail-focused company, and its retail business and Jio business would be the key growth drivers in the future. Reliance Retail is growing at 30% CAGR in last 4 years with both organic and inorganic growth. In FY23, Reliance Retail had spent 10,000 crore rupees in acquisition. Recently, it's announced the acquisition of Metro Cash and Carry for around 2,850 crore. Then 5G has just started, and that would continue to increase Reliance ARPU, that is average revenue per user. Not only that, Jio is also penetrating into the entire digital ecosystem of India with 20 plus apps, including Jio TV, Jio Cinema, Jio Money, and so on. Currently, Reliance is trading at levels of 2,560 with PE ratio of 27. So from current levels, Reliance can potentially generate up to 20% return in 2023. Then 8th stock in my list is from auto sector. After almost 4-5 years of slowdown, auto sector in India has shown strong signs of recovery, and one stock that is looking very attractive for 2023 is Mahindra & Mahindra. Mahindra & Mahindra has always been known for its cult followership of SUVs right from the days of Scorpio. And this cult followership is continuing with crazy demand for 3 of its flagship SUVs, XUV 700, Thar and new Scorpio. You can visit any showroom and check the waiting period for these SUVs. And waiting period is as high as 10 months. That itself speaks about the growth potential. Company's management has also indicated that manufacturing of its digital SUV, XUV 400, will begin by Q3 of FY23 end. Now that's from the demand side. If you look at the costing, the commodity pricing are now softening, and that would contribute in the improvement in margin. Company has already hiked the prices for tractors and its SUV recently. All these developments would directly result in better profitability in 2023. Now as far as Tata Motor is concerned, since a major business of Tata Motor comes from US and Europe, I am slightly skeptical on its growth prospect in near term. But again, Tata Motor is very well positioned for long-term growth. But for now, I would pick Mahindra & Mahindra for buying. Its current market price is around 1250 with a PE ratio of around 18.6. And I'm expecting 20 to 25% return potential from Mahindra & Mahindra in 2023. If there is any positive development in US and Europe, we'll cover Tata Motors in the near future. Now, 9th stock in my list is from pharma sector. Although pharma sector is still in pressure, but there is one stock that I would suggest adding in systematic manner, and that is Divis Lab. Divis Lab saw a sharp growth during COVID, which resulted in exponential jump in its share price. However, pharma sector saw fall in demand post-COVID that resulted in fall in earning and eventually profit booking. And Divis was no different. Even its share price tanked 27% to current levels of 3,400 with current P ratio of 30. But if you have 4-5 years of viewpoint, at current levels, Divis has created a great buying opportunity. Although there can be further weakness for next couple of quarters, and that might result in further 10-15% correction. But I think that Divis can be accumulated from current levels and can be added on every dip. Because in the long term, API sector in India is bound to grow. A, because global pharma companies are reducing their dependency from China on API. And B, even Indian government is trying to reduce the dependency from China on API import. Both these trends have created humongous growth potential for Divis Lab as it is the world's leading generic API manufacturer. So in the next few months, I don't see any immediate trigger in Divis, but this is the time to systematically add Divis in 2023 on every dip for great return in coming years. Now, final stock in my list is from one of the most promising sector, that is defense sector. And my preferred pick would be Hindustan Aeronautics Limited. I've covered the in-depth business of HAL a few months ago. It is a leading aircraft manufacturer of India. And defense is very sensitive sector where government would always prefer government-owned companies like HAL. That is the reason after government focused on reducing dependency from foreign countries and focused on indigenous production, the order book of HAL swelled to current levels of 84,000 crore, which is more than 3 times its last 12 months revenue. Company's profits have also grown at much faster rate from 1987 crore in FY18 to 5,885 crore in trailing 12 months, representing 3x jump in last 4.5 years. Although the share has more than doubled in last 1 year, but even after this jump, Hindustan Aeronautics command a P ratio of 14.4, which is still looking very attractive. Hence, there can be another return potential of 25% in 2023. Now, if you observe, I did not recommend my most favorite IT sector. Simple reason is ongoing concern in US and Europe. So companies that generate major business from India would largely benefit in 2023. And IT sector that generates major business from US and Europe can see further correction. Although IT sector is still down 27% from its peak, but there is no major immediate trigger for IT stocks. Another 10-15% correction would make IT stocks worth adding. So basically in IT stocks, things might get even worse in early 2023 before it starts to get better in later part of 2023. Hence, for now we can skip IT stocks. I'll cover them once I find more valuation comfort and once the global situation would see recovery. But for now, my preferred pick for 2023 include ICICI Bank, HDFC Bank, Axis Bank from banking sector, HUL and ITC from FMCG sector, then L&T from infra, Reliance from retail and telecom, then Mahindra and Mahindra from auto, Divis from pharma, and HL from defense. Please note that, as mentioned, there can be further volatility in the market, so don't expect immediate return in short term. These stocks are looking good for accumulation in 2023 in a staggered manner for next few months starting now. I hope you'll find this video useful. I'll see you next video. Till then, take care.